Welcome to RealCast, the weekly roundup of the real asset markets. My name's Richard Betts and I'm joined by James Wallace, Nicole Dines and Dan Innes. James, let's start with you. What have you been following?
Yeah, the Chancellor, Rishi Sunak, unveiled the government's winter economy plan in the House of Commons on Thursday. Sunak confirmed plans to end the furlough scheme, which has already cost about £40 billion to date, and replace it with the Jobs Support Scheme, which is effectively a wage subsidy plan similar to the scheme in Germany, which is designed to protect only viable jobs across companies that are facing lower demand over the winter months because of the coronavirus. So under the scheme, which is slated to last for at least 6 months, the government will subsidise employees' wages for those working at least a third of their usual hours. So this policy shift sort of amounts to, if you like, to a transition from the government carrying the burden of job support in the economy to a burden sharing between the government and employers. And it's also an acknowledgement that many of the jobs no longer exist outside of the artificial protection of the furlough scheme. In addition, the government has extended the temporary reduction in VAT down to 5%, which will help sectors, notably in tourism and leisure and hospitality and retail, and that's until the end of March next year. And that kind of sort of is further acknowledgement that sectors like that have really had have been affected severely by the pandemic. So these measures were all part of a coordinated attempt to sort of soften the impact of the new national restrictions that Boris Johnson announced the day before on Wednesday. And they're expected to last, as I said earlier, for at least 6 months. Some of these restrictions include, as we all know, a sort of 10 p.m. curfew on pubs and restaurants, and more pressingly for our sector, a U-turn on encouraging workers back to offices. So there's been some early assessments as to sort of how much all of this new raft of policies might cost. Capital Economics have suggested that it could be as much as £5 billion, and that would take the total cost of the government's support to the economy to the region of £200 billion, which is just under 9% of GDP. And as soon as you sort of add in the adverse effects of public finances from the weak economy over a sort of a longer period of time, Capital Economics suggests that this will spiral to as high as $370 billion as a total bill to the taxpayer. And of course, many inside and outside the government are expecting tighter restrictions to follow in sort of the weeks ahead. And that will only add to an already darkened economic outlook. So the Chancellor will come under a lot of pressure if to provide more support to households and businesses if the pace of new cases of coronavirus continues to rise or doesn't slow sufficiently. So overall, it's a precarious balance between the sort of judicious use of our public finances, safeguarding public health and stimulating economic recovery. All very difficult stuff. Boris Johnson's government is seemingly now less focused on preventing a surge in unemployment and business closures, and is clearly sort of pivoting towards adapting to a permanent adjustment of the UK economy. And that includes sort of weaker growth rates and higher levels of joblessness. And that's not to mention the spectre of a possible no trade deal with the EU vis-a-vis Brexit by the end of this year. So this winter economy plan is you can see it sort of marks a sort of a step change in the approach by the government. And I think many expect that this will lead probably in the new year to a wave of struggling businesses collapsing.
Well, that's a fantastically upbeat start to the programme, James. Interesting also to see that the UK is kind of coming into line a little bit with what's happening in Germany and France as well. And there seems to be more kind of cohesion in a way with the responses across Europe now. Dan, what have you been seeing?
First up, I've got the news about Blackstone. Once again in the headlines, they've raised a record €7 billion for their latest property debt fund. The US management giant has announced the final close of its most recent real estate debt fund, and it's already got this €7 billion of total capital commitment secured already. And that's almost double the amount they raised in its predecessing fund in 2016, which makes it the largest real estate credit fund ever raised. So whilst we were all at RealX and watching that last week, Blackstone emerged as the preferred bidder on the Prologis Platform as well. And that's a €524 million deal. And that would make that the UK's largest warehouse investment sale on record. So it's been a bit of a week of records tumbling despite COVID. But elsewhere, we've seen The Swedish private equity firm EQT, they've made their debut into the UK housing market this week with a plan to build £1 billion worth of build-to-rent homes in and around London. They sort of committed an initial 300 million to build 3,000 flats over a period of about 5 years in a JV with Sigma Capital, who themselves have been putting sort of about 16 million. The government has actually helped with £50 million worth of a loan to help this joint venture. And that's going to target sites with good transport links in more affordable boroughs out in outer London, such as Ealing, Enfield, Havering. So Louisa Clarence Smith at the Times reported that the deal is the latest to involve private equity firms such as Blackstone, big financial institutions, including Legal & General, investing in these UK affordable and rental housing products. And of course, we've spoken in the past about Moda Living and Apache Capital. But yeah, I mean, this EQT Sigma joint venture, they've already secured 7 projects, and those 7 are going to bring about, 518 homes. So watch that space. And then lastly, going over to the US, Brookfield, they're planning to sell a swathe of their malls. And obviously we've been following the Intu story, the Hammerson share price story over the last few weeks and months. But they're planning to sell several malls and also cut up to 1 in 5 jobs, which is sad to hear. I mean, it's been described as a bit of a drastic overhaul of its retail unit. And it pretty much says a lot about the US mall sector and the state that's in. But I mean, the FT reported last week that the retail chief executive at Brookfield, Jared Chapela, said that sort of cuts were to align with the future scale of their portfolio. So we're kind of looking at a 20% cut in the scale of that portfolio. And you'll remember in June that I reported on the stories here on RealCast about letters being sent to investors, how rent collection had fallen to just 35%, and it faced numerous bankruptcies. By the end of June, at least 7 of its malls had already defaulted on their mortgages. And in July, Brookfield even renegotiated a $6.4 billion credit facility with its banks. And you'll remember the Brookfield Property Partners, took on 100 of these US malls when they merged with General Growth Properties back in 2018.
It's interesting, especially that focus on real estate debt. That seems to be a discussion that we've been having a lot also in the interviews that we've been doing. Nicole, what have you been seeing?
Well, Dan was just mentioning this EQT, the Swedish private equity group, and its investment in the UK. Well, they've been very busy because they've invested in Italy as well. They have bought Casa.it, which was a pioneer in the sector, one of the biggest online platforms of real estate in Italy, and they bought it from Oakley Capital. It was a pioneer because it was founded in 1996, so long before the sector took off in Italy. And it's interesting because the Swedish group, EQT, which is huge, it's got sort of 40 billion euros under management, only the week before had bought Idealista, which I mentioned on RealCast a couple of weeks ago, for 1.3 billion euros, which is again the biggest property portal in Spain, Portugal, and in Italy. So again, very much a bet on online. And yes, private equity, as Dan was mentioning, very, very, very much active in the sector at the moment. And in general, having followed RealX Global and other seminars online, there seems to be a sort of positive theme running through about how real estate can lead the recovery. In places like Italy, we've seen Milan, obviously, with urban regeneration playing a huge part in bringing about economic recovery. And we're seeing it in Greece. There was this very interesting announcement by the Prime Minister that this Hellinikon project, which is set to totally transform the coastline around Athens, which had been talked about for years. It's an 8 billion euro project. So this announcement in the middle of what is still a very profound crisis is obviously very significant, and it very much points to that Greece, obviously the real estate was a huge, especially the hospitality sector, was a huge part of the economy, and it is set to lead back to the economic recovery. So signals both in Italy and in Greece that seems to be the way to go.
Yes, that was interesting. Also at the session that we did at RealX on Greece, Hilda Alessandratou of Enterprise Greece, one of the things she said was that real estate has always been a pillar of the Greek economy and is expected to play a significant role in the recovery. after the pandemic. And I thought that was an interesting take on exactly what you've been saying there. Thanks, Nicole. Thank you, Dan. Thank you, James. Thank you for joining us, and look forward to seeing you next week for our roundup of the key themes in real assets. Thank you.